Good morning, everybody. Thank you for joining our webinar. We'll start shortly. Let's just wait for more people to join. Let's say in about 10 minutes, 5 to 10 minutes. Thank you so much for joining once again. Welcome everyone. Welcome to the new participant joining. Welcome David. Welcome Wale. Taiwo, welcome. Thank you for joining us. Thank you. Welcome everyone. We'll be starting shortly. Good morning once again, everyone. We are officially starting this webinar. My name is Udozo Chimwaya, and I am thrilled to be your host for today's exciting webinar. As a communications executive, I thrive on connecting people with ideas that drive growth. And that's exactly what we're here to do today. So today's section is all about equipping you with the tools and insights to navigate your statutory HR obligations with confidence. So if you're here to learn, share, network, you are in the right place. So let me give you a rundown on what it's about before I introduce our facilitators. So understanding your statutory HR obligations by and Mr. Welcome once again. So the key objectives of this webinar will be to, make you understand key statutory obligations for HR and businesses in Nigeria, gain insights into the laws, agencies, and penalties associated with non-compliance, learn the importance of timely remittance and accurate filing. I really hope you all can hear me. So this is one of our facilitator, Adewale. If you've been following us since last year, Adewale won't be a strange face to you all. So he serves as a human resource consultant at Kimberly Ryan, and he leads the outsourcing and L&D units. And our next facilitator is Insikak Samuel Udo. He's the finance manager at Kimberly Ryan Limited, and he's a very detailed-oriented professional, who is very passionate about finance. So we brought the experts to give you guys knowledge on this webinar session. So without further ado, I would advise you guys to have a paper and a pen. If you have questions, your suggestions, we would like to take them after the webinar. So without much further ado, Adewale Fashino, I will pass it over to you to start the webinar. Thank you very much.
All right, Chimaya, thank you very much for that wonderful introduction, and welcome to every one of us that have joined us, and thanks for those that have been with us since last year to this point. So today we are looking at something that is very critical. I believe that majority of us here might be HR people, or maybe not HR, maybe we are administrators in our organizations. Chimaya, can you please mute everybody? I'm getting a feedback from someone, please. I think from David. Okay, thank you very much. Mr. David Eke, please, can you please mute your mic? I'm getting feedback from you, please. Okay, thank you very much. All right, so we are looking at the topic today that I think is very important, and no better time in the year to look at the statutory obligations that we have as Kimberly Ryan. Sorry, as HR professionals. And you agree with me that if you look at the landscape of Nigeria in the past, let's say, well, 1.5 years, you will notice that the government seems to be shifting more towards statutory. There have been a lot of uproar regarding the tax reforms. We are seeing a lot of the agencies that have been docile before starting to talk, like NSITF. We all know before now NSITF has been quite quiet, but all of a sudden now they are talking now. So that shows us that a lot of things are about to shift. And it's very important that we are compliant. Even if in the past years we've been able to get away with some of these things, I think it's important that we know that this year things might shift a little. And the body language of the government is that everybody must do the right thing. And who better to drive some aspect of this than the HR personnel in the organization? So that's why we'll be looking at statutories, more of the things that have to do with HR, but maybe some of the other statutories within the organization that we might be able to advise maybe some of her colleagues on what to do. So before I start, right, I would like to take a few feedbacks from us. I would like to take maybe 2 or 3 people to let me know what are there particular areas that we are struggling in terms of statutory. Is it payee? Is it pension? So that this will also give us, the facilitators, an idea of what we are working with here. And 1 or 2 people, please, you can just unmute your mic and speak. If you'd like to give us 1 or 2 areas that you feel, okay, I'm struggling. Last year we struggled with this. Okay, Kingsley, I think you are unmuted. Please go ahead, Kingsley. Oh, Kingsley, okay, I don't think it's oh, okay. So is there anyone that wants to please go ahead to share with us any part of the statutory that we're having challenges with, whether it's payee, whether it's pension, whether it's NSITF, that maybe in terms of remittance or in terms of computation or in terms of dealing with the regulatory bodies involved? Is there anyone that would like to share before we start the webinar proper? so that we can be able to put context to this. Anybody? Anybody? Anyone? Or we are clear, or we are just waiting for us to kickstart? Okay, it seems no one is willing to share. Okay, so maybe we just go ahead. I believe along the line, we'll have time where we'll take questions. So from there, we can now ask our questions or give clarity. All right, thank you very much, Kingsley. Said we should carry on. Okay, so today this is just an overview of what we are looking at today. So the statutories that have to do with HR, we'll be able to put them into one bracket. So we have the pension contribution, as we all know. We have the National Social Insurance Trust Fund, that's the NSITF. We have the ITF, Industrial Training Fund. We have the PE, that's the tax, that's the big one. And then we're also looking at some of the other statutory like the annual returns, the VAT, and the likes. And then I believe that by the end of this session today, we'll be well equipped to handle all these things. So let's go proper into what we have today. So an overview of the statutory obligations that we have. So if we look at it, what are statutory obligations? I believe we are all familiar with this, but let me just go over it again. That these are the mandatory requirements by law that organizations must comply with, right? Designed to ensure fair labor practice, taxation compliance, and financial transparency. I remember there's something that they say in the US, I've heard it in quite a number of movies. They said there are two things that are constant in life. What are they? They say death and taxes, right? Which means that whether we like it or not, taxes or on the broader note, statutories, they are constant. Government will always come for something, right? So it's important that we know these things and we know how to apply them. So why is compliance important, right? Number one, to avoid legal penalties. I don't know if there are any one of us here who have ever had issues with the tax authority that they've had to arrest, or pension authority. It's always very complex and very difficult situation if you find yourself in that situation. Why? Because beyond the fact that you have to pay excessively, it could also be embarrassing because they could seal the organizations, seal the door of the organizations, or the likes. I know some of us might have experienced a case where Lagos IRS would come and paste something on our door, non-compliance. And we know how embarrassing it could be when your clients or customers are coming in and they are seeing such on your door. Then, of course, also to maintain company reputation. I've talked about this. Then to contribute to the national economy and workforce development. All that we do as well, taxes, we all know that the essence of taxes is, and the other, what do you call it, statutories, is to build the nation. So these are some of the things. So next now we'll go into full details of each of these, starting from pension contribution. So to go ahead there, we have our finance experts in-house, and just to put a bit of context to know why we brought him here today. At Kimberly Ryan, beyond just being an HR consulting firm, we also handle outsourcing briefs for clients across board, both local and international. So we have quite a number of employees that we deal with. And then because we work across board, not just across like 36 states in the whole 36 states in Nigeria, and also some other neighboring African countries, we've had cases, we have cause to deal with a number of these regulatory bodies. And the man behind the scene is our finance manager, who, like I said, is vastly experienced and he has done this. So yeah, I'm very sure by the time he's done teaching us these things, we would have enough in our tank to go for the year. So please, if you have questions, you can drop them on the chat box. Chimoya will pick them. And also when the time is right for the question and answer, Insikak would be tending to that, why Chimoya coordinates. So without further ado, I would like to welcome our finance manager, Mr. Insikak Udo. Insikak, please, over to you.
Yeah, good morning, Wally. Good morning, everyone. Thank you for the introduction. Thank you, Chimoya, for also introducing today's webinar. Like Wally rightly said, statutory is very, very important in the life of every organization. And we are just going to be looking at way at which we can improve on whatever we are doing. And for us that are not compliant, we should start doing like Wale rightly said, the government are very, very strong on statutory remittance in this period. So we are just going to go straight to the first one we have here, which is pension contribution. So we look at the overview. In terms of overview, it's pension is being governed by the Pension Reform Act of 2014. It's been administered by the National Pencom Commission. Now for pension, before an organization starts remitting pension, it means you have to have been registered with Pencom. That will be, you will have a Pencom number before you start remitting. Now the contribution rate. So for the employer, we have 10% of monthly emolument, and then we have the 8% of monthly emolument, which in total, you are to remit 18% of your salary as, 18% is to be remitted to the government in terms of pension. Now, what it to add is that aside what the company remits for you and whatever you remit from your gross, you are also allowed.
Hello, House. Apologies, Mr. Udo. Sorry to cut you. I think the coordinator should just mute everybody. There are lots of feedback that are interfering with what you are presenting, please. Maybe Madam Chinaya can just mute everybody automatically so that we can hear you and you alone. Thank you.
Please, can you mute everybody, please? Okay. Okay, so like I was saying, in addition, aside from the 18% that it's coming from the contribution, it is also worthy to mention that in pension, there's what is called voluntary contribution. So aside from the contribution that is coming from your gross pay and from what your employer has to contribute to you, you can also voluntarily say, okay, on a monthly basis, I want to add 20,000, 30,000 to my remittance. So that's on that. For the timeline for remittance, contributions must be remitted 7 days after payment of salaries.
I don't like to travel alone. People are going to travel like this.
Jessica, please, you are muted. I think, please check, you are muted. Apologies.
Okay. Okay, so let me start again from the timeline for remittance. Okay, timeline for remittance is contribution must be remitted 7 days after payment of salary. What that means is after you have paid your employee salary, 7 days after, you are entitled to have remit their pension. Pension is not, I see some companies hold on to pension. Pension is not your money. It's part of the employee's salary. So it's part of salary. So as soon as you remit, paid salary, you are 7 days after, you are supposed to remit pension. So penalties for non-compliance, employer pays outstanding contributions plus 2% interest per month. And just to mention, this 2% is not going to the government. It's actually going to the employee that you have failed to remit for. So if you are not remit for any employee as at a month, you are to pay 2% interest on each of the months that you are owing that employee. So the objective of this pension is to ensure that employees' financial security after retirement is, so their future in terms of retirement is being secured. So that's what pension is for. Then we have the second one, which is Industrial Training Fund, ITF. So overview, it was established under the ITF Act of 1971. It's administered by the Industrial Training Fund Agency. Then key details are 1% of the employer's annual payroll. So whatever is your payroll total, 1% is expected to be remitted to the ITF as a contribution. Now, eligible companies are organizations with employee more than 5. Now, employees, so you are all an annual turnover of 50 million. So it means any organization that has employees more than 5 Next. Okay, timeline for remittance. Contribution must be made. Now, it is also worthy to mention here that sometimes because you want to do annually, it's always very taxing. So you are allowed to make your remittance on a monthly basis. You don't have to wait till end of the year before you make your remittance. You can remit it on a monthly basis. You are allowed to do it through remitter, and then the technology system has really helped us now. You can generate your invoice through remitter and remit on a monthly basis, and then at the end of the year you collate it and then submit it as your contribution for the year. So penalties for non-compliance, you are fine plus payment of arrears. There is a fine involved in it, plus you paid arrears. Then the objective of this is it's actually fund training programs for workforce skills and development. Now, what most of us don't know is part of the funds you use to finance your employees' training in the year, you can actually be reimbursed by the ITF. Once you are able to tender your receipts or what you have spent for your employees' training, as far as you are a compliance person, as far as you are a compliance company, you are allowed to file for reimbursement from the ITF agency. Now we go to the next one, which is National Social Insurance Trust Fund. That is the NSITF. And the overview is it's governed by the Employee Compensation Act of 2010. It's administered by the NSITF Management Board. The key details is that it's also a 1% of employees' total monthly payroll. So 1% of the total payroll per month is to be remitted. Now, contributions are made either monthly, quarterly, or annually. So like I said before, for the same thing apply here. If you cannot do your remittance on an annual or quarterly basis, you are allowed to do it on a monthly basis. Now, penalty for non-compliance, penalty as specified under the Compliance Act. And the Compliance Act here said that if you are a non-compliance, that you are to pay 5% of the amount unpaid. So it means if you don't pay, you are supposed to pay whenever you are remitted. You are to add 5% of any outstanding you have and remit it. So that's the penalty for non-compliance. Objective, it provides compensation for work-related injuries, disables, or death. So these funds are being kept in case there is a work-related injuries or there's a disability or death. So that's what this is meant for. Are we together? Okay.
Yes, please.
So the The next one is pay as you earn, which is payee. And this is for all the states in Nigeria. Every state is entitled to receive payee, and every company in Nigeria, you are entitled to remit payee on behalf of your employee. So we look at the overview of this.
No.
So the overview is governed by the Personal Income Tax Act, which is PITA, administered by the State Internal Revenue Service where the employee is reside. So in any state that you are supposed to remit to the state revenue service. So, and it's basically paid in the state that you reside. Wherever you are working, it's where you reside. So that's where you are supposed to remit your payee. Now the key details here is a gradual rate ranging from 7% to 27%, depending on your income. So it's a pay as you earn system. It doesn't have a certain percentage based on, you cannot say, okay, because I'm on 20,000, I should be paying this. So it's a pay as you earn system. It ranges from 7% to 24%, depending on whatever your income. So what this means is the higher you earn, the higher tax you pay. The lower you earn, the lower tax you pay. So that's how the payee system works. On timeline for remittance, payee is always remitted Okay, let me take that again. I was muted. Remittance is make 10 days of the following month. Now, it means that when you are finished paying your salary, you are expected to remit payee on or before the 10th of the next month. So let's assume your payee, it is assumed right now, your payee for December should have been remitted on or before on the 10th of January. That's the deadline timeline for that. For penalty for non-compliance, there is a fine and potential legal action. And some of the fine are, most of the fines for payee are always on, they use monetary rates in terms of the interest you are paying. Whenever you fail to remit, any month that you fail to remit, it is assumed you are owing the government the amount you are supposed to remit plus interest, depending on the interest prevailing interest rate as at that time, as being prescribed by CBN. So just note that whatever you are owing, that's on the 10th you have not remit, you are supposed to pay interest on that amount. Then objective is to ensure employees' income taxes are collected and remitted to the government. That's the main objective of that. So you are just like a channel, an intermediary between for collecting the payee from the employee to the government. So you are not supposed to hold on to it. You are just receiving it as a company and remitting it on behalf of the employee. Now we go to the next one, which is value added tax. I think most of this has to do with most of the people that are accountants or finance manager in the house would know this. Now, value added tax is being governed by the Value Added Tax Act of 1993, administered by the Federal Inland Revenue Service. Now the details is VAT rate is 7.5% on either the goods and services you render. Now, it's also worthy to mention here that the way VAT is being remitted is very, very peculiar because we had what we call the input and the output VAT. Now, when you carry out a service for an organization, okay, let's even take, for instance, goods. You purchase goods to resell. Now, when you buy a goods from a vendor, he adds tax, VAT to his invoice. So that VAT that is being added to that invoice that you are receiving from whoever vendor you are buying anything from is called the input VAT. And then when you now render a service or you sell the goods back to the final consumer, you are allowed to add another VAT there, which is called output VAT. So what you remit to the government, it's because you have paid VAT to somebody, and then you are receiving VAT from somebody. So you are allowed to do what we call differences. So you deduct your input VAT from your output VAT, and whatever is the difference is what you are remitting to the government. That's how VAT system works. So it's not just that because you receive 7.5, you are supposed to collate whatever you have also paid as VAT to a supplier. You are supposed to collate it, and then you deduct it from whatever you have received on behalf of the government. Now, the timeline for VAT remittance is as follows: 21st day of the following month. So like we are now, it is expected that on the 21st of last month, you will have remitted your VAT for December. Now, it's also worthy to mention that as at 2023 or so, the FIRS introduced a model where you no longer file your VAT manually. You have to go through the tax promas to file your VAT. Now, if you don't, on a monthly basis, it is expected of you before the 21st, you will have filed your VAT on tax promas, generate it, and make payment. So that's how it is right now. So the timeline is 21st day of every month. Now, penalty for non-compliance. Now, penalty is 50,000 for the first month, and the subsequent month that you have not remit, you pay 25,000. And there is also an interest on that money you did not remit. There's an interest. So, and it's not, once you file on tax promas, the tax is calculating itself. The penalty is calculating itself. So you cannot go there and adjust and say, no, I didn't do it. It's whatever is being calculated. So once you did not file on the 21st of the month, it means you have 50,000. Now, 22nd, an interest is being added. So like that, on a daily basis, an interest is being added to what you have not paid. So it's also worthy for us to take note of that, because once you do not file and make that payment immediately, interest, and you are still going to pay the penalty, still going to pay the amount that you are supposed to pay. So now the objective is generate revenue for the government from consumption of goods and services. Annual returns. Now, annual returns is being governed by the Company and Alliance Matters Act, CAMA. Now, it is being administered by Corporate Affairs Commission, that is CAC. Now, key details is annual returns must be filed not later than 30th June of every year for the preceding year. So it means that from this January, you are expected to have started filing for annual returns as at date. So there is even, I think we saw some memo that came out that as at 31st of this month, if you have not filed for your annual return, you pay a penalty, which we really don't know how true that was. But note that annual returns, you are supposed to file annual returns on a yearly basis. This has nothing to do with your annual financial filing. This is just your annual return showing that your company still exists, that you still do business, you are still in operation. So because you registered with CAC, you are supposed to be updating your information with them on a yearly basis to show that you are still in existence. Now, penalty for non-compliance, you are to pay 25,000 naira the first month of non-payment, non-filing, and then 5,000 for each subsequent month of defer. So any month that you defer to make your filing, the first month you defer is 25,000. Every subsequent month is 5,000. So sometimes when you go for your annual filing, most of the filings, some of us run it through the lawyers. You'll see that the money that the lawyers will ask you to pay is more than 25,000 because you did not file for a certain year. So imagine some of us that have company running and we have not filed for like 2 years, 3 years. So the first month of non-filing is 25,000. So the other months that you did not file is 5,000 on each of the months. So it means you have to pay a lot of money for filing instead of not paying at all, because if you are filed on time, you are not supposed to pay anything. Now, the objective is to ensure transparency, accountability, and also to know the status of your business operation. Like I mentioned before, is also to keep the CAC informed that your business is still in operation. So that, because once you don't file, one of the things we should also take note is that once you don't file, your status on the CAC is going to be showing inactive. So it shows that you are not an active organization. It's showing it's going to show inactive. If you have a business, a proposal you have submitted, and the person you are doing business with decide to check your status with CAC once, and it's in public domain, so anybody can see it. Once you go to CAC site, you are able to see company if it is active or not. So you are able to see that. So I would encourage every one of us that we should take filing with the CAC very, very important on a yearly basis. Now we have the annual financial filing. Now, overview, it's required under the CAMA and law tax, and then it's administered by the CAC and FIRS. Now, the key details is document to files. You have to have done your audited financial statement. That means you are supposed to have prepared your financial report at the year, depending on your year end, the company year end date. So some companies year end is 31st, some companies June, and so on. So depending on your year end, so you are supposed to have prepared a financial report and then submit your audited account, and then you go ahead and file. Now, filing must be done within the 6 months after the end of the financial year. So it means if your financial year end is 31st of December, you are to file in June. Your deadline for filing is June. If depending on your financial year end. So if your financial year end is in March, you are expected to file in September. So penalty for non-compliance, fines and restriction on business premises, like Wale rightly said, most time you see FIRS will come and paste this thing on your a non-restriction on your door. And sometimes FIRS they are very blunt in terms of how they carry out their own activities. Once you do not do what you are supposed to do, your office can even be locked and you are not allowed access into your office. So we must ensure that at every year, financial year end, we make our filings and then pay our company income tax, because that is the purpose. Once you finish your filing, you are supposed to pay company income tax, depending on which category of company you file in. Like we have the small scale, we have the medium, and then we have the large scale. Like now for small scale, those are the companies that your revenue is below 50 million and you are not entitled to pay CIT. Then for medium scale business, your revenue you should have a turnover within 50 million to 100 million, and your CIT is within 20%. And then if you are a large scale business, your revenue is within 100 million upwards, and your CIT rate is 30%. So the summary of the obligation is as below. We have ITF, like I rightly said, is Pension Reform Act of, we have Pension Reform Act. The agency is PENCOM. The rate is 18% of your payroll emolument. Then 7 days, timeline is 7 days payment of salary after payment of salary. Penalty is 2% monthly interest. ITF, we have the ITF Act 1971. Agency is ITF. Rate is 1% of payroll. Timeline is annually. Then penalty is you pay the arrears and then you pay fine. Then NSITF, we have the ECA 2010 Act, which is the agency is the NSITF board, and then 1% of the payroll is to be paid. And then it's also being paid monthly or quarterly. And then for ITF2, you can also, like I said before, you can also pay monthly, depending on how you want to pay. And then for ITF, also note that before you could be able to pay ITF, you should have registered. And they also have a portal. Once you fill your payroll details on the portal, it's automatically generate the amount you pay, and then you just print it. And then also most time you need to call and talk to somebody in ITF for approval before you can make payment. They have to approve on the portal before you can make payment. So I just wanted to also note that. Then the penalty for NSITF is specific penalties, which I mentioned the other time. Then payee is a PITA. It's been the agency is State Internal Revenue Service, and then rate is from 7% upward. Like I said, is a pay-as-you-earn system, so it doesn't necessarily mean there's a certain percentage on it. Then the timeline is 10th of every month, and then the fine, like I said, is an interest. It's using the commercial rate. Then VAT is being the act is VAT Act 1993. The agency is FRS. The percentage is 7.5%. It's supposed to be, deadline is 21st of the next month. Then penalty is 50,000 and 25,000 on subsequent month that you did not remit. Then annual return, the act is CAMA Act, and then the agency is CAC. Then timeline is you are supposed to have filed your with CAC on 30th of June for every year. Then the penalty is 25,000 or more. Thank you very much. So we are allowed to ask questions.
Good day, Mr. Isika.
Yeah.
Thank you very much for this very insightful presentation. A lot of takeaways from there, but I have a couple of questions. May I proceed, please?
Yeah, you can proceed, please.
All right, thank you. The first one has to borders on the first item, which is pension. In your presentation, you said 18% is jointly contributed by the employer and, of course, the employee. While aside from that, if I got you correctly, you are also at liberty as an employee to do some voluntary contribution to enhance your savings. But I want to ask regarding that, is there any certain percentage or threshold by which you cannot go beyond in terms of percentage against whatever that is left of your salary that you cannot contribute beyond? You know, like for instance, in my own organization, you can access loans or forms of loans, compassionate, you have the cooperative loan, but whatever loan that you are collecting, at the computation of your monthly payback has to allow for you to have at least a take home of 50% of your monthly salary. So in light of that, is there a threshold of the maximum of whatever voluntary contribution? Because I know there could be some employees of some certain organizations who, of course, will have other businesses, private businesses running and see this as a way of better securing their later life or their future by pulling so much amount of money from their or from whatever that is left after the 18%, or is it 8% from the side of the employee? So is there a legislation that pegs that amount or the percentage of whatever you can pay? If you get that correction, that's a question clearly. And the second and the last question we have to do with the VAT. I want to share an experience with us. We are a service rendering company. I'm a sales manager in my establishment, and we served an invoice to a client of ours on an international shipping. We actually we are a courier company, Red Star Express, an affiliate of or a sister company of FedEx, which is commonly known everywhere. So we served this our client, flour mills to be precise, an invoice in November, last year, November. And by the time they remitted or they paid for that invoice, they did not pay us with the VAT. They withheld, of course, the withholding tax from the contract sum, withheld it, and of course did not even add back the VAT element of that invoice. When we got across to them to explain the reason as to why that invoice was treated as such, they got back to us saying that shipment that we picked for them was an international transaction, which we agreed to. We took that package to Greece, and that there's a legislation around it that allows for whichever transaction that's done within the free trade zone for exports, free trade zone for exports, non-vatable. I don't know how much you can share, how much more light you can shed on that. According to him, he said the legislation was put in place to encourage exports. You understand? So I don't know if you can also take that question along that of pension that I raised. Thank you very much.
Okay, thank you very much, Motayo. Okay, so I would start with the pension remittance. Now, as an employer, you are only allowed voluntary contribution based on your salary. So if you are doing any other business outside your organization, you are not allowed, because you are registered as a remittance within that company. So whatever money outside your salary is not allowed to be remitted as voluntary as far as you remain as an employee of a company. It is only when probably you are not working again, you now have a business, that you can do voluntary contribution as a person. Now, come to the company. So every organization has their internal policy. Like I remember there is an organization that I work for that you are not allowed, deductions from your salary is not allowed to be more than one third of your salary. So it means that the other part, 3/4 of your salary is supposed to be your net salary, your take home. So any deductions from your salary that is more than 1/3, we are not allowed to deduct more than that from your salary. So in terms of loan, whatever you are, so if you have a threshold, a company that has such policy, like you said, your company, you are allowed 50% of your amount. So if your deduction in your entire deduction in the organization, you are able to do maybe like 30%, and then you still say, okay, the 20% that is remaining, let me remit it as a voluntary remission. It's for you to just send a letter to your HR that out of my net salary, I want to still remit 20% as well. So it is the HR that will remit it on your behalf, not you remitting it, transferring the money to the PFA. So it's going to be added to whatever the 18% and remitted on your behalf. So, but it's just going to be in the column of voluntary remittance. I don't know if you get my explanation. So
that is clear.
It depends on what
I was just, sorry, sir, what I was just trying to establish or to learn is if there is, I can understand there could be variances from company to company in terms of policy direction.
Yeah.
You understand, internal policy. But then I'm just asking if there is an umbrella legislation from the PENCOM that you cannot do more than this. You understand?
No,
irrespective of what your internal workings could be, then you cannot do this. All right.
Yeah,
so
it's
on a company to company basis, policy to policy basis.
Policy to internal policy basis.
All right. Thank you very much. That is very clear. You can let me take the VAT issue.
Then concerning the VAT, so there are some companies that are exempted from payment of VAT, and some of them we have like a memo that came out last year. I think some oil and gas are exempted from paying tax. I mean VAT. There is the like the agency, like embassies, they are exempted from. So if you put VAT in their invoice, they won't pay. So we need to take, you need to look at some of the companies you are working with and then be able to find out if they are exempted from paying tax so that you don't end up still continuing adding VAT when you are invoicing them. So we have some as an organization that we don't, when we are invoicing them, we know they are exempted from VAT. We don't VAT them at all. Like the embassies, and they are all. It's also worthy to mention also that there are some companies you put VAT in their invoice, and they will withhold that VAT. It was a law that was made in 2023. People like banks, oil and gas. So if you have VAT in your invoice for a service you render to either an oil and gas company or a bank, they will withhold it and pay it on your behalf. It's using the withholding tax method. So they won't pay it to you. They don't remit it to you again. They pay it on your behalf. So you are allowed to either request for evidence of remission and the rest.
Good afternoon. Can I ask a question?
Okay.
Okay. My question is this, Mr. Udo. You mentioned that the only remittance that can go into your pension remittance is from the salary. How about companies that pay profit sharing? Like when there is a profit sharing and people don't want to claim that money, can they not remit it into their pension account?
Okay, so like I said before now, that it depends on the internal policy of the company. So you are allowed to remit that. Of course, that is being governed by the internal process of that particular organization. If a company is sharing profit, that means you are earning an extra money aside your salary. So the company knows that if you remit that profit into your as a voluntary contribution, you still have your salary to sustain you for the month. So you are allowed to remit in terms of profit into your pension. You are allowed to remit. It just depends on the policy of that organization. If the organization said the profit sharing, you cannot remit more than 50%. So it means you can't remit everything. You are only allowed to remit 40. The other 50, they expect you to take it home.
Okay, thank you very much. It's clear for me.
Rashida, please.
Good afternoon, everyone. Thank you, Mr. Tak. Thank you, Adewale, for this informative session. My question is, as an employee, is there a way you can confirm that your organization is remitting your payee on your behalf? And is there any way you can take legal action against them if they are not? Thank you.
Okay, so for payee, there's what we call annual filing with every state's internal revenue. So a company can be paying payee with the list of the employees and not file. So at that point, you are not able to see your payee at the back end. If you check with your tax ID, you won't be able to see it. But once they do filing and you have your tax ID, once it is being filed, I think Lagos State is January. Every January you file for Lagos State, and the deadline is always on the 31st of every month. Of January. Like for this January, by tomorrow is the deadline. After tomorrow, you don't file for your employer's payee, you have penalties to pay, which is I think 500,000 for corporate bodies. So once 31st of the month has come and the company confirmed that they have filed for you, you are supposed to be able to check from your own back end with your tax ID that the money is in your personal account, which is with your tax ID, it's been assigned to you that this money was remitted. Of course, you can take legal action if you find out the company is not remitting on your behalf, because at the end of the day, if you are looking for your tax clearance, you are not able to get it because the employer didn't pay your tax. You are not able to get it. So you are allowed to either file for it, file a complaint or sue that company for it.
All right, that answers my question. Thank you very much.
Thank you.
Please, there are some questions in the comments. I would like to read them out, if you don't mind. So, Foforola asks, can you differentiate it between payee and personal income tax? And who can file the personal income tax? And she also asked, for a company that just started up and has less than 5 employees, can the company pay pension? Secondly, for an employee that has been paying pension before, but joined a new organization, how can she be remitting her pension for pay individually? Thirdly, how can the company register to get seen to start remitting pay of the employees?
Okay, so let's take the question. The first question was what? Let me take it one by one.
Okay, so the first question is, can you differentiate between payee and personal income tax? And who can file personal income tax?
Okay, so payee is being paid from the organization. That's an organization you are working for, pay your payee. Now for personal income tax, it's on the individual. So you are a business person. So you are, of course, you know the business is actually different from individual. You pay yourself some salaries or you have some income you earn from your business. You are supposed to pay tax from whatever you earn from your business. And filing for that is actually always on the 31st of March. So individual file and make payment for themselves for personal income tax. And there is also the aspect of withholding tax for contractors. And I think for withholding tax, it is the people that gave you contract that is supposed to remit it on your behalf. So if you have a contract with someone and they deduct withholding tax from your payment, you are allowed to request for evidence of remittance from them. So payee by the company is being remitted and filed by the company. Personal income tax from you as a person, which you are earning extra money either from your business you do or from dividends you earn and so on. So you pay personal income tax, you file with the state revenue authority, and then you pay that tax. So I don't know if that answered that question. Then the second one was what?
So the second question is, for a company that just started up and has less than 5 employees, can the company pay pension? Secondly, for an employee that has been paying pension before but joined a new organization, how can she be remitting her pension or pay?
Okay, let me take these two first. These two first. The first one was sorry again. The first one was what?
The first one was for a company that just started up and has less than 5 employees, can the company pay pension?
No. So once you have less than 5 employees, you are not allowed to remit pension. You have to have more than 5 employees to be able to administer pension. Then for the second one, which is for somebody that's already remitting tax with an organization and then move to another organization, how does the company? So now for that, you are just supposed to submit your pension PIN that the other organization was remitting for you. You are not supposed to open another go to meet another PFA and open another pension. You are just supposed to, whatever PIN they were using to remit for you. Of course, the PIN is like your account number. It's like your account number. Once you have opened it, it's a lifetime account. So once you are leaving an organization, you are going with your PIN, your personal document. So you submit it to the HR of the new company, and they will continue remit with the PFA name. They will continue remitting with that PFA. Then the last question was what? Sorry.
So the third question is, how can the company register to get teams to start remitting pay of the employees?
So you register with PENCOM. You register with PENCOM to start remitting pension.
Okay, thank you, Isikak. Kofowala, I hope your question has been answered. If you still have more comments, you can leave them in the chat box. Then there's another question. According to your recent explanations on pay and PITE, what that means that personal income tax is not to be paid by employees. So the person is asking if personal income tax is not supposed to be paid by employees.
Personal income tax is not paid by the employee, because the employee is working in an organization that paid payee. Payee is pay as you earn. So the company remits payee on your behalf. Personal income tax is personal to you. You have a business, you have an extra income, an extra business outside, either outside your employment that you are earning. So you are supposed to file for personal income tax and then make payment for that. That's an extra income. Or you are not working with anybody. You own your own business. Whatever income you earn from that business, you are supposed to pay personal income tax.
There's also another question or two questions. So Ishemadi said, I noticed you didn't mention NHS. Could you please throw more light on NHS and also state where the deductions would come from, either from net or gross salary?
Is Wale still here?
I'm not sure. Isika, please, did you get the question?
Sorry, I'm coming.
Okay.
So for NHS, so most time NHS is being contributed from the employer. It's the employer that is making that contribution so that for in case of a business accident and injured in the place of work. So it's the employer. It's not supposed to be taking part of the employee gross also.
Okay, there's another question. So where does the deduction from the obligations come from? National Health Insurance Scheme, NHIS, and Nigerian Social Insurance Trust Fund, NSITF. Is it from gross or net salary?
So for NSITF and ITF, it's an obligation to the company, to the organization. NSITF and ITF is an obligation to the organization. So it doesn't come from your gross, it doesn't come from your net. It is an extra obligation like the employer pension contribution. It's same thing.
Hello, Mr. Udo.
Yeah.
This is Tomotayo again, please.
Okay.
All right, thank you. So for withholding tax, you mentioned that maybe a couple of years ago, government had gone with withholding tax remittances, which I also know about, the Tax Pro Max platform. However, there were a few of our clients that had made remittances on our behalf, but when we checked our own Tax Pro Max, we noticed that those monies did not reflect. Upon follow-up, what we usually discovered, we had the likes of Guinness, we had the likes of Chief Farmer and I think FCMB at the time. What we discovered was that there was a reference number, which was not our TIN number on the invoice. It was another number, maybe it's VAT or whatever number, okay, that we provided. And it is with that they had remitted those monies. And perhaps those were the reasons why we didn't get value for those monies, or we didn't see them reflect on our Tax Pro Max. So I don't know the technicalities around that platform because I'm not in our tax unit. I just need some form of enlightenment. Whenever we go for reprocessing of that particular payment, because of course it will go to the government, but it will not drop for us to net off against our yearly
Your CIT.
CIT obligations. Okay, so what we were requested to provide for the reprocessing was no longer our TIN number, but Tax Pro Max TIN. Can you please shed more light on that? What is the difference between our TIN number and the Tax Pro Max TIN? And why is it that if there is an error in the processing, the initial processing of withholding tax on that Tax Pro Max platform, why is it that we can still not reprocess, still using that TIN number, but this time around the Tax Pro Max TIN? Take me through the technicalities around that. Thank you.
Okay, so as at when the Tax Pro Max was the operation for Tax Pro Max started, so there is always this. You know that before you can open a Tax Pro Max, you have to have an email, and it's not on the company; it's on a personal. It's on a personal email that you can be able to So whatever when you open a tax promas, there's always a number added to your TIN. So let's assume your TIN end with 01. There's always another number, an extra number added.
An extended number, yes.
An extended number. So they are not able to trace it with that your tax because they want to trace it on tax promas. It's specific to tax promas because they want to trace it with tax promas. So they need the till for tax promas because most of what is being paid, you can only access it on tax promas. You cannot access it anywhere. You can't access it using the normal thing. That normal thing is not recognized by tax promas. It is the extended thing that is being recognized in tax promas. So, so it's just linked. Like when you have a link account together, two accounts are being linked together. That's the way it works. So it uses the other account, but when it drops on the tax promas. Tax promas become the resident, like where you can hold it responsible.
Okay.
That's the
Thank you very much.
Technicality.
Lastly, sorry, I'm taking too much of time. I know I'm not the only participant in this on this call, but please let me just make let me have the full privilege of getting all that I need to get. Lastly, this will be my last question because I also want to drop off the call because I have a meeting to join shortly within my system. I know that when you net off your withholding tax, the output and the input, just like you mentioned earlier during your presentation, you have the opportunity of using the positive difference to to net off against your CIT at the end of the year. However, if you have a negative balance after the net off, what happens? Are you still to remit that balance to the government?
I've never witnessed a situation where you have negative balance. I've never, because whatever you are going to be, so if you are given, if we have a goods that let's use goods for example. If you have a goods you have bought and then you have an input VAT. Let's assume 10,000 of 10% of 10,000, which is 1,000. That means you've paid 11,000. Your VAT there is 1,000. Now, if you are selling that goods, you are not going to sell it for 11,000. You are definitely going to sell it for 12,000. That means you are making an internal profit of 1,000. Imagine. And 10%, I mean 7.5 of this thing.
10,000 will always be less than that of 11.
You understand? So there is no way you can have a negative but after you have input and output.
Okay, thank you. But I am actually talking about the withholding tax and not VAT. You know, the withholding tax is always on contract sum on the invoice, excluding the VAT element on that invoice.
Okay, you are talking about withholding tax is always remitted, used to deduct. It's not. No, you were talking about input and output VAT. I know you mentioned it. It doesn't have to do with withholding tax. So
I know there are different workings.
Input and output actually is on VAT. Okay. Withholding tax is just remitted on your behalf at the end of the year when you file, do your annual filing. Whatever is your CIT, if your withholding tax can carry it, you use it to settle it. If it cannot carry it, it means you pay extra money to the government.
Yeah. All right. Thank you. So of course, I can always reach out to you.
Whatever is your balance is still for you. You are not allowed to collect it.
I know. Of course, so we can advance this conversation. I'll call you. I have to drop off the call. I crave your indulgence to so do. I have a meeting to attend. Thank you so much for having me on the call. Have a wonderful day, everyone.
Thank you, Amataya.
Isika, there's still some pending questions, and I think this will be the last questions we take so that we can round up. So somebody is still asking for more explanation on NHF, National Housing Fund, and NHIS, and National Health Insurance Scheme. Would you like to explain that further?
Just a minute.
Okay. So before that, there's another question. For a company that started just barely 3 months, how do we begin with these obligations? However, we're already complying to pay.
So a company that just started 3 months, once you have since they have already started with pay, once you are having revenue, you are declaring revenue, you are supposed to have started with FRS, registered with FRS. They will create a portal, a link, distinct for an account for you on Tax Promas. So once they create an account for you on Tax Promas, you are supposed to go there and be filing on a monthly basis. So there is no timeline for that. You can still go there and get created on Tax Promas and start filing for VAT. And then for pension, if you have employee more than 5, you are supposed to approach PenCom and then register and start remitting pension. NSITF, same thing apply. Approach their office. You are going to be register with them and start remitting. Don't wait until it is 1 year. So act now. Register across all these bodies so that you are able to remit. Because if you don't register, you are not allowed to remit. Every one of them has a number that you remit with. That number is assigned to only your organization. That's what you use in remitting. So if you don't register with them, there is no way. So the first thing to do is to register with them, and then you start remitting. Once you register, they give you a number, you commence.
Okay, thank you, Sika. I think this is the last question before the NHS explanation. So Paul asked, since you are talking about pension, can you throw more light on 25% RSA?
Can I throw more light on what, please?
25% RSA. RSA.
RSA, 25%. I don't really understand that question.
I think the person is trying to ask about the 25% that one can get when you are out of job. 25% of your pension.
Sorry. Okay. Okay, so for pension, if you are out of job for 6 months, you are entitled to get 25%. So what you do is approach your PFA. Once you approach them, you submit all necessary documents to show that you are out of job for 6 months. Once you do that, you are allowed to withdraw 25% of your total pension contribution. So, but it is just once in your lifetime. So you can only withdraw just once. As long as you withdraw once, you are not allowed to withdraw again until when you retire, until when you reach the age to be able to access it.
Thank you. Jessica. I hope your question
I think for the NHIS, you can drop our emails for that person so that we share more light to that person personally. I don't have enough information yet to answer that question.
Okay, no problem, we'll do.
Okay, thank you.
No further question. There'll be no further questions. Thank you, everyone, for joining our webinar on statutory obligations. It's It's honestly our pleasure, and we hope to see you all in our upcoming webinars. So if you look at the chat box, you see our social media platforms, links to our social media platforms. You can get engaged, get updated with our events, our L&D training programs, our upcoming webinars. We are available. So please just follow us on social media to stay updated on our offerings. And once again, thank you so much for joining this webinar. We hope to see you going forward. And if you have more questions, just leave them in the chat box. We'll reach out to you. And yes, you're going to get the recording of this webinar. The webinar will be shared with everyone that attended. Thank you so much again, once again. Thank you, Insikak, for that wonderful presentation. Thank you, Wale, and thank you everyone for asking your questions. It means a lot to us. So we'll see you next time we hope to see you next time on our upcoming webinars. Thank you once again.
Thank you very much. This is a lovely session. We have learned a lot. Thank you.
Thank you, Benga.
Thank you.
Thank you.
Welcome. Welcome. Thank you so much. If it's not too much, I'm seeing your comments. If it's not too much, you can post the webinar flyers on our socials and say it was very insightful. That will also be really appreciative. Thank you so much.